What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is November 2nd of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, we got to talk about the upcoming FOMC meeting. Papa Jerome Powell is going to be putting down the hammer, letting us know whether or not markets are ready to start moving higher or start moving lower. And it couldn't come at a better time with how price action is across the board and markets, from crypto to stocks to even commodities and the bond and currency markets. This is really an ultimatum moment here, guys. And we're going to talk about that as we go through the video. But I really want to focus in on one big thing. Is Jerome Powell and the Federal Reserve ready to pivot? This has been the big talk of the town here. We talked about it a little bit in the last video, but I want to do a little bit more of a comprehensive view here and really solidify my predictions here, because I think at the end of the day, you got to have some skin in the game. You got to be able to make your calls, make your bets, make them confidently. And I want to spend a little bit of time to talk about why I don't agree with this narrative that the Fed is going to be pivoting and what this will mean for Bitcoin, stocks, and the whole lot of the market. If you guys like this video, drop a like, consider subscribing. You won't want to miss this one. Let's go ahead and kick it off. So we'll come back here to this very serious demeanor photo of Jerome Powell here, tilting the glasses down. We'll come back to that a little bit later on. But I just want to go ahead, I want to highlight the charts here that I think really signify just how much of an impactful point we're at right now with this Fed decision. You've got Bitcoin here, which has broken above its descending line of resistance, but we've also got the 200-day moving averages crossing those 200-week moving averages, a first in the entire history of Bitcoin. A very significant indicator here. This is not just in Bitcoin, but also in equities as well. The 200-day and 200-week have significant value. This cross is very, very concerning. But we can take a look across the board here and the different indexes or indices for equities. We've got the NASDAQ holding by a thread on that 200-week, getting rejected each and every time. The 200-day moving average, especially back in August during that Jackson Hole speech, where Jerome Powell made it very clear that the Fed is focused on tightening and increasing interest rates. But to be fair, there are some more positive plays. As you go from the high-risk plays like the NASDAQ all the way up to the more mid-risk or low-risk plays, such as the S&P 500 and the Dow Jones, you find that we're tracking right in between, off of a bounce from that 200-week, right in the middle between those two major moving averages. And at the top of it, with a strong super rally here in the month of October, the Dow Jones bouncing up from the 28,000, 29,000 point range all the way up to practically 33,000, holding above the 200-day moving average. Is this another deviation like we've seen multiple times here throughout the bear market? Or is this going to be able to hold and bounce off of a potential Fed pivot or some change in direction? Let's take a look at the VIX here, right? VIX holding on a thin line here on that 200-day moving average, usually sometimes serving as support, but we've seen it many times breaking through, waiting for a retest down here towards that 200-week. Volatility has been softening here in the market, and this is one of the big talking points of the bulls here, getting them very excited of a potential Fed pivot and a future rally in equities. Let's take a look here at the currency and bond markets. Taking a look at the US 30-year yield holding flat here with where we were back here at around mid-October. Far extended away from those moving averages as we've been breaking out since as far back as March 2022. Can we continue to see the US 30-year yield move higher? Or the dollar currency index here, tracking the dollar against other global currencies like the Japanese yen, still ticking higher here, still setting in generally higher lows over time, but now it's starting to enter into potential either flag or descending channel that could be the end of the trend. And last but not least here, we've got natural gas and oil both coiling in between those 200-week moving averages and those 200-day moving averages, starting to signal that this is a make-or-break moment here for commodities. The whole chessboard is out in display, folks. I mean, this is really an exciting time. I'm not just fluffing this up. I think this is going to be a moment to watch here in financial markets. And I think that the markets have placed their bets. Those who are exposed to assets or really driving the direction of assets have a very clear narrative here. If you talk to any of the major kind of Wall Street types, those out there who have been playing in the previous bull market, a lot of them are very excited about a Fed pivot. And this has become almost to a degree. And I think this is why we've seen the bond yields starting to slow a little bit here in the 30-year yield, right? Over the past couple days, there's been a growing consensus that there's going to be a Fed pivot here in the market. But I want to go ahead back as we continue to scan throughout the market here, as we see the FANG stocks, excluding Apple here, talking about Amazon, Netflix, Google, name it, all the major tech stocks, Meta, all down around 56%. I want to go back here to what really matters. Papa Jerome Powell taking his glasses down. Grandpa Powell coming out here and letting us know whether or not it's going to be time to pivot. Because there can be market rumors. People can want something to happen. But we got to know what the data is looking like. Jerome Powell has been very clear here that the Federal Reserve is trying to save face. It is trying to get back into the driver's seat and clamp down on inflation. Because for the past decade, the Fed didn't have to deal with this. They just kept monetary easing going on every time something got bad. There was much more incentive for them to do that back then than basically to not do it, because they didn't want to let anything break at the time. But you can't care about something breaking in the system due to taking too much risk when you've got out of control inflation. And you guys have probably felt this yourselves in your day-to-day lives, but if you look across the metrics, as we will talk about later on, inflation, the labor market, the things that the Fed has indicated it cares about are still out of control. Now we're going to play a little bit here of an analysis game on what Jerome Powell has said in previous meetings. If you go back to the Jackson Hole speech, you go back to the previous FOMC meeting, Jerome Powell's message has been very clear. And I got to be honest, I've given a ton of crap to the Fed over the past couple of years. I've emphasized the point of them saying one thing and doing another. But it's very important to understand how much less, I'm going to make sure I say that right, how little the Fed is able to deviate here during periods of inflation. This dynamic has not been at play to this degree since the 1970s. And Jerome Powell is at the driver's seat here trying to clamp down on it. So there are three things Jerome Powell has talked about that he would consider for a pivot. And when we talk about this question of pivot, we got to understand what are those three things. There are three items here. There is the labor market, there is inflation readings, and on top of that as well, slowdowns in GDP growth. Okay, these are the three things. If you go back, he was very, very clear here. He's been very direct. Anytime the reporters try to ask, but when could a potential pivot come, this and that, and they're trying to ask for the numbers for the target interest rate, for the federal funds rate, all these different details that could help to maybe give market gurus a way to predict when the bottom is in. When in reality, Jerome Powell said very clearly he doesn't care about what the equity markets, what crypto for that matter is doing. He cares about three things. He cares about inflation. Priority number one is inflation. Softening labor market conditions, indicative of declining wages here, a slowdown in demand in the economy, a slowdown of excess growth, and on top of that, slowing economic growth through GDP metrics. So let's go ahead and just take a look through these, right? You guys don't have to agree with me. You can be on the completely opposite end of the spectrum here. I love getting people with different opinions here on the channel. I'm not here to build an echo chamber. Let's just go ahead and take a look at those data points. One of the big things that came out as of recent, probably the second most important point here for Jerome Powell, is the U.S. job openings. In the month of September, whereas many people have been expecting continuous month-over-month declines in the labor market, considering the Fed rate hikes as of recent, with how aggressive they've been, one of the fastest accelerations in history, we just had a major bump up in the month of September after the decline we saw back in August, okay? So let's go ahead and just see how bad this got, right? There's about 1.9 job openings for every unemployed worker right now as of the month of September. Now, to visualize this data here, a lot of people were getting really excited about the decline we had seen from the nearly 12 million job opening peak back here around the mid part of 2022. And we got a pretty big drop here in August. But what we've just got now is a spike up to 10.7 million, adding 400,000 new job openings in a month where probably many people expected that we would see net zero growth or potential declines. Now, I want to make it very clear here, guys. The Federal Reserve wants to see a much lower ratio, and this is really one of the important dynamics here outside of the job openings themselves. They want to see a much lower degree of job openings per individuals employed, right? And this means that the labor market would be softening, that there is too much recession risk or too much decline in growth to where the Fed would consider potentially starting to pivot. But right now, they can't do that. The labor market is still incredibly strong. If you are looking for a job right now, that ratio of job openings is still practically up where it was before. It's at 1.86 on the ratio. The height back a couple months ago, around that peak near 12 million jobs, was around 2 jobs for every unemployed person. So the second most valuable point here that the Fed cares about is not showing any serious signs of weakness. We need to see, as you guys have seen throughout history here, a much more moderate ratio somewhere around 1.25, like we were back here before the pandemic. That's what we need to see here. We are not seeing that at the moment. We are nearly at around 50 to 75% more than what we are usually at throughout history. That is not good to see. That means that if we're relying on the labor market here, that is not a sign to pivot. Let's go ahead and take a look at point number 1, the most valuable metric here for the Federal Reserve, and that is inflation. We talked about this in our previous video a little bit, but I just want to, again, go ahead and hit it home here. Look at the PCE, look at the CPI, those 2 big inflation measures that the Fed is using here. We can take a look at the annualized numbers, which I understand some people have a gripe with, so we'll take a look at the monthly as well, right? I think it's very important to look at both of them. Take a look at that annual number. Right, the Fed's target, let's just go ahead and reiterate it here, is to get down towards around 2%, a level we have not seen since March of 2021. If we take a look back over the past couple of months, throughout 2022, so far we have been hanging around 6%. That's 6.25% of the annual metric. And this metric, bear in mind, on the annual one is what the Fed is using. It needs to get down to that 2% target. We're still at 6% here as of the most recent reading. We just got it the other day here for the month of September. It actually ticked up slightly, right? So we're not seeing that deflation in the economy. We're not seeing the decline in the month-over-month growth. We can take a look at the core PCE. Again, we're taking a look at the core PCE. This is a very favorable metric, a very easy one for the Fed to get down to 2% versus the CPI, right? Much easier here as it doesn't factor in the increasing cost of housing, which has really been a huge part of inflation, as much as the CPI. Take a look at that month-to-month read. From August to September, unchanged. Month-over-month growth of 0.5%, practically on par with some of the highest month-over-month growth rates like we saw back here in April and what we had continuously throughout the majority of the fall and winter in 2021. This is not looking good, folks. This is not the kind of material I'd want to see for a Fed pivot. But again, let's just not get siloed here. Let's take a look at the CPI, right? This is really the benchmark rate that the Federal Reserve is following. Now, we do see a little bit of decline here, what could very well be the beginning of a top here. I'm not doubting that for a second, guys. If the Fed keeps on pace with what they're doing and doesn't pivot, that was likely the top at 9%. If the Federal Reserve really keeps this aggressive rate hiking of 75 basis points and reduction of their balance sheet like we talked about in the last video, that's one of the important dynamics I'm going to be listening out for here in this meeting. We're at 8.2%. Let's take a look at that month-over-month reading, right? Because people are thinking that, with a month or two or a couple months, we're really going to start declining into 4%, 5%, really start hitting near that Fed target of 2%. Month-over-month growth has been expanding since back in July. We got one monthly read of 0.02%, not 2%, 0.02% deflation in prices. And after that, another tick up higher. The Fed does not have a grip on it just yet. Now, some people will argue here that if the Fed can keep it at this range for a while, the annualized figure is going to start getting towards that 2% target. And that's a very fair point to make. But it's important to understand that the Fed has made it very clear it is not going to pivot until we reach that 2% point. It is not going to change direction until inflation gets back to its target. That is priority number one. And if you guys understand, if you take a look back at the 70s, right? I know a lot of us here, including myself, I've only started investing since the previous secular bull run that started in around 2012, 2013. All right, that's when my investing journey started. But I've been in the game here for about 10 years. I've spent a lot of that time looking back at the previous waves of inflation. And you got to understand that inflation is not to be played with. It is something that you need to address swiftly. And the Fed understands this. So we got to look at the third final thing here, right? If the Fed really is far, far away from pivoting due to the jobs market, due to inflation, perhaps maybe GDP is the saving grace. Perhaps a slowing economy, a potential recession, something breaking is what could keep the Fed from continuing its hawkish path and consider a pivot to start slowing the rate of growth in the federal funds rate and potentially stop its balance sheet reduction. and maybe even tolerate a little bit of inflation in the economy. Let's take a look at GDP. This is something that slipped a lot of the headlines as a reason because so many people are talking about inflation because it's hitting us so hard here. Quarterly growth or decline in the GDP, right? We had 2 negative quarters of GDP, typical definition of textbooks, recession, right? Some people disagree with that. That is what's been utilized for decades in economics. So let's take a look here at what we got here, right? We're in a recession, right? And we just got a 2.6% increase in GDP. Now, I really want to take a step back here, guys, because first off, let's just make something clear. GDP numbers can be fluffed. Same as the CPI, same with any kind of metric you look at, especially when you're coming up towards midterms, coming up towards election cycles. Both parties have done this before. Put some weight into trying to fluff up the numbers, make it look a little bit good, right? But put that aside here, right? Let's just go ahead and take a look at either reality here. Either GDP is worse than this, which means we are still in a recession, but not enough to a degree where it's completely obvious, right? Which means we likely have more pain to go. There's usually more capitulation. Or worse off, if these metrics are honest, if we are still seeing 2.6% growth when the Federal Reserve is hiking rates to its highest level in practically 20 years, and we're seeing mortgage rates at 7%, and treasury yields on bonds at some of their highest levels in decades, that is an incredibly worrying sign. And there's a reason why it's an incredibly worrying sign. Because it doesn't mean that right now people are needing to borrow capital to go out and buy goods and services. It means that the Federal Reserve has created way too much money. That 40% of the entire money supply that's ever existed, that was issued over those last 2 years during the pandemic, is still out there. It is still propping up property prices. People are using cash to buy properties. And again, this isn't, not just everyday people. This is really institutional investors that are buying up properties. This is, again, a lot of the excess money from the stimulus checks and higher salaries that people are getting as we're getting towards the peak here, right? The late stages of this previous secular bull run, where salaries and expenses are eating up the balance sheets of companies. And again, leading towards more consumer confidence than there should be right now. That is what's driving inflation. Those two dynamics are huge right now. And it's what may lead GDP to potentially being positive here for a quarter. So what's my main point here? My main point is that you look across any of the 3 metrics that Jerome Powell, and I would love if you guys want to mention any other metrics. I'm open to criticism. I'm open to hearing your thoughts. Feel free to leave it down below. If there are any metrics that I missed that Jerome Powell has mentioned are significant, put them down below. That might indicate a pivot here. I know some people would mention potentially Credit Suisse or Deutsche Bank or some bank potentially going under, or insolvency, not just on a company scale, but potentially government scales, as a lot of companies are getting crushed by a strong dollar. I get these points. But Jerome Powell has one objective right now. He needs to tame inflation. And if he doesn't deal with it today, it'll be twice as hard for him to do it a year out from now if he pivots here today, where he's going to have to tighten even more aggressively. Don't believe me? Look back at the 70s. Money and monetary dynamics do not change. The supply chain issues that have been persistent for the last few years are going to continue being persistent because it takes a decade to build everything in a way where we were able to get the supplies and services, goods and services that we have taken for granted so much in a globalized economy, now going towards more of a localized framework. It's going to take years to build out. New plants, new entire networks of companies. We can't rely on things like that. And as I look across Twitter today, I'm starting to see a little bit of realization here. I'm seeing a lot of names that I know. I'm seeing Keith McCullough as well, over from Hedgeye, who's a really interesting guy. He's been dead on here. You get Danielle DiMartino Booth, who was previously working at the Fed. A lot of people coming out here and calling out pretty much what's going on here, which is a lot of hopium. And you even got the Biden administration. I don't mean to be political here, but the Biden administration saying we support the Fed's eventual pivot. Right? We support the idea that the Fed should pivot here. I don't remember hearing Jerome Powell say that we're going to be pivoting. Did you guys get the memo? Did you guys get a report of that? I mean, what is the market smoking here? Take a look out there at your local grocery store. Rental prices, home prices. And at these current mortgage rates and these costs to borrow and spend money, it tells me that there's too much cash in the system. And Jerome Powell, he knows this. He knows this. And today we are going to see a lot of tilted glasses here, making it very clear that while the market may want something, it doesn't always get what it wants. It got what it wanted for the last decade. But inflation has come back into the picture, and that changes the game forever. It will change the trajectory of where the Fed is going to take monetary policy for the next few years to come. And if we can't accept that reality, if we can't hedge ourselves, have some dollar exposure, not be all in on assets like we were during those risk-on periods, there's a lot of risk that you could get crushed during that period of time. And I just simply would say, take a look back at the dot-com bubble, take a look back at 2008, and think of whether or not you're ready to go through that, potentially holding positions like in the dot-com bubble that never came back, many of which went to zero, or on top of that, potentially took decades, 10 years plus, to come back up. We're going to see what happens today, folks. It all is in the Fed's hands. But I hope you all enjoyed this video here. I hope it provided food for thought. I'm sorry for rambling, getting a bit emotional here, but my main goal here is to just focus on the data, guys. I don't have any incentive for asset markets to go down. I mean, for Pete's sake, I run a YouTube channel that is focused on crypto and the macro environment. But the good thing is we can make money both ways. We know how to go long. We know how to go short here, right? And there are ways to make money both ways here. And we're going to continue to cover the macro environment. I'm going to do my best to be as honest with you guys as possible here. But right now, we're mainly in cash, right? We're keeping a bit cautious here. We don't need to pick a bottom. We'll wait until the trend gives us the right signs. We'll wait until the Fed tells us what it's going to do. Because I can promise you all, the worst thing you can do right now is fight the Fed. And Jerome Powell, with his very serious stare, has made it very clear what his 3 objectives are, and they have not been met. If you guys like this video, drop a like. Thank you all so much for watching. Leave a comment down below on your thoughts, and I hope you guys have a wonderful FOMC day. Take care, everyone.